Good morning. As we look at the board heading into Friday, October 24th, 2025, the U.S. markets are currently closed. We need to look at yesterday's action to set the stage, and for Lithium Americas Corp., ticker LAC, it was not a quiet session. The stock closed yesterday's trading on Thursday, October 23rd at $6.475 per share, finishing the day sharply in the red, down $0.215 or 3.21%. This move continues the intense volatility that has defined this name for the past several weeks, a stock that seems to be trapped in a violent tug-of-war between massive federal support and deep Wall Street skepticism. Now, seeing a 3% drop might not shock you, especially in a speculative mining stock. But here is the insight that complicates the picture. This drop happened just 3 days after the company announced arguably its most significant milestone to date, the first $435 million drawdown from its massive $2.26 billion conditional loan from the U.S. Department of Energy. The expectation, the common narrative, is that when a pre-revenue company gets a massive government check, the stock stabilizes. The reality we just witnessed is the exact opposite. The market shrugged off the good news and continued to push the stock lower, following the brutal 21% collapse we saw just a week ago after a major bank downgrade. This tells us the market is no longer trading the promise of Thacker Pass, it's now trying to price the risk of Thacker Pass, and that changes everything. Let's establish the common ground, the story that everyone who owns this stock, whether in an individual brokerage account at Fidelity or through the Robinhood app, believes. The narrative for LAC is simple and incredibly compelling. It is the 100% owner of the Thacker Pass project in Nevada, the largest known lithium resource in North America. In a world scrambling to build a non-Chinese supply chain for EV batteries, the critical component for companies like Tesla, Lithium Americas is positioned as the great American hope. They have a $2.26 billion loan commitment from the U.S. government, which sees this project as a matter of national security. And they have a cornerstone partner in General Motors, which has not only invested in the company, but also signed an offtake agreement for 100% of the lithium from Phase 1. You have the asset, you have the funding, and you have the customer. On paper, it looks like a straight line to success. Many investors look at this setup and see a clear path to riches, a ground floor investment in the next great materials giant. But the reality, the reason the stock closed at $6.48 and not $20, is that this is anything but a sure bet. The market is challenging this rosy expectation with a cold dose of reality. The central risk, the one that keeps institutional managers awake at night, has nothing to do with funding or customers. It has to do with chemistry and engineering. Lithium Americas is attempting to commercially extract lithium from claystone using acid leaching process. The problem? This specific method has not been successfully commercialized at this scale anywhere in the world. The company is, quite literally, building the factory while finalizing the recipe. This is not like digging iron out of the ground, it's a massive, complex chemical processing operation. And the timeline is still years away. The company itself states it doesn't expect first production until late 2027, with a ramp-up to 40,000 tons per year happening in 2028. For an investor used to buying Apple stock or Nvidia stock and seeing quarterly results, this is an exercise in extreme patience. This is why many financial advisors would suggest a diversified approach, perhaps using tools like Schwab Intelligent Portfolios or SoFi Robo-Advisors, rather than making an oversized bet on a single pre-revenue mining company. The risk profile is just in a different universe. This brings us to the recent whiplash-inducing stock movement. Let's trace it. In late September, the stock went on an unbelievable run, soaring 130% in just 2 days. This was triggered by reports that the Trump administration, as part of renegotiating the DOE loan, was seeking an equity stake in the company. The market interpreted this as the ultimate government backstop. But then on October 16th, JP Morgan stepped in and dropped a bomb. They downgraded the stock to underweight, slapping a $5 price target on it, a target that is significantly below where it closed yesterday. Their reasoning was precisely what we just discussed. They called the valuation expensive and argued that the government's involvement isn't a reason for the stock to be worth more, but rather a lifeline it needed to survive in a difficult market. The stock imploded, falling 21.7% in a single day. The volume that day was astronomical, a clear sign of capitulation and panic selling from retail investors, using platforms from Fidelity Investments to SoFi Invest. So when the company proudly announced on October 20th that it had received the first $435 million tranche of that DOE loan, the market's reaction was telling. There was no rally. The stock flatlined and then, as we saw yesterday, continued its drift lower. The expectation was funding secured, stock rallies. The reality is, funding was expected, the execution risk remains, and the analysts are scared. The market is forward-looking. The loan is old news. The downgrades and the $5 price target are the new reality it's grappling with. Yesterday's trading volume of around 16.6 million shares was significantly lower than the 30-day average, which suggests the panic has subsided, but the conviction to buy the dip just isn't there yet. We are in a holding pattern, with the bears who are shorting the stock on platforms like Interactive Brokers battling the long-term bulls who believe in the 2028 story. Let's quickly cover what this company actually is, now that it's a pure play on Thacker Pass. Following its corporate separation, the company spun off its Argentinian assets into a new entity. The Lithium Americas Corp that trades on the NYSE is only the Nevada project. This was a smart move to simplify the story for U.S. investors. The company currently has zero revenue. Its financial statements are pure cash burn. In the second quarter of 2025, it posted a net loss of $12.45 million. This is a development stage company, plain and simple. Its value is not in its earnings. Its value is 100% tied to the future estimated value of the lithium it's sitting on, discounted back to today. And that discount rate is what analysts are fighting over. How much do you penalize the stock for the technological risk and the long wait? JP Morgan, Scotiabank, and BMO have all issued downgrades or cautious notes, pointing to this exact risk. The consensus rating among the 16 analysts who cover the stock is reduce, with an average price target of around $530. This is a stark contrast to the institutional ownership. The smart industrial partners are all in. General Motors is one of the largest shareholders. Hancock Prospecting, run by Australian mining magnate Gina Rinehart, is also a massive holder. They aren't trading the day-to-day. They are strategic partners who have done their engineering due diligence and are willing to wait 5 years. The conflict, then, is between the long-term strategic industrial holders and the short-term financial analysts who have to answer for their stock picks every quarter. For the average person engaging in self-investing, it's a difficult position. Do you bet with GM or with JP Morgan? Many are turning to online investment tools, using the Fidelity mobile app or the Robinhood stock trading platform to take small positions, treating it almost like a lottery ticket. Others are looking at the volatility and prefer to stick to Fidelity ETFs or Fidelity mutual funds that might hold LAC, but in a much smaller, diversified way. Now let's look to the future, because that's all this stock is. The bull case is clear. The company uses the $435 million in new cash to successfully advance construction at Thacker Pass. They hit their 2025 and 2026 construction milestones. They prove the clay-leaching technology works at scale in their pilot facility. The lithium spot price, which has been weak, begins to recover as EV demand continues to soak up global supply. If these things happen, the analyst targets will be revised upwards and the stock will move significantly higher long before the first ton of lithium is ever sold. The government backing and the GM offtake agreement provide a huge margin of safety on the financial and demand side. The bear case is equally stark. The $2.26 billion loan, while massive, may not even be enough. These mega projects are notorious for cost overruns. Construction could hit delays due to permitting appeals, labor shortages, or supply chain issues. And the biggest risk of all, the technology fails. If they can't extract the lithium at the costs they've projected, the entire project's economics collapse. In that scenario, the GM offtake is worthless